The last week was be one for the history books. A VIX over 65, a flash crash, and panic in the Japanese yen. Now that the markets are in sync, should we focus here or look elsewhere? Interestingly, 4 out of the last 5 pullbacks had a similar setup, a failed bear flag. Today, we'll explore what's next for the markets and why this chart might reveal more than expected. Bitcoin rejected the level we discussed last time, and oil hit its first target, with more potential ahead. Let's dive into stocks, commodities, and cryptos for the week. This one's going to be exciting. Let's get started. Hello, ladies and gentlemen. A huge welcome back to everyone to the special weekend edition of Markets Around the World. My name is K2, and as usual, we'll be covering everything from the latest data and macro news stories to the key levels you need to be watching. If you love markets like we do, remember to subscribe and educate yourself better about how these markets actually work together. So, let's talk about what happened in the market and the outlook too. Let's expand the conversation, starting with the news. Wall Street is growing concerned about the US economy, with American households feeling the strain. This week's economic and earnings reports could impact the stock market's recovery from its worst day in 2 years. US stocks ended a volatile week after Japanese yen-fueled trading and fears of a weakening economy unsettled global markets. Major indexes nearly reversed their weekly losses. Attention now turns to upcoming US economic data, including July's CPI report, retail sales updates, and earnings from top retailers. Investors will be watching to see if higher inflation and interest rates are putting more pressure on American households. Beware the vibes of August. August is known for its market turbulence, from the 1990 Kuwait invasion to the 2011 U.S. credit rating cut. This August, stocks began with a 3-day decline, culminating in a 3% drop for the S&P 500 on the first day, its biggest one-day drop in nearly 2 years. Though stocks saw a turnaround on Tuesday, they ended the day lower. Wednesday's market wobbled, but the S&P 500 closed the week strong, with its best back-to-back performance of 2024 and a notable single-day gain on Thursday. The stock market crashed, and unemployment soared, but the music thrived. Joe Foster, 27, recalls the Great Recession as nights spent at under-18 clubs in London, dancing to Lady Gaga, Kesha, and the Black Eyed Peas. A wise man once said that signs of financial ruin include empty strip clubs and brilliant pop music. The latter is the essence of recession pop, a term for the dance pop hits that dominated the airwaves after the 2007-09 financial crisis. Over the past week, signs emerged of a weary consumer, reduced spending at amusement parks, delayed vacation bookings, and investor concerns about the U.S. job market and the Federal Reserve's actions, though some downplayed recent stock market declines. This week we'll hear from major retailers, Home Depot on Tuesday and Walmart on Thursday. Walmart's stock has surged nearly 30% this year, as inflation drives shoppers to its lower prices. However, its results may not reflect broader retail trends. Many investors view last Monday's market meltdown as a mere technical blip, believing the economy is fine and that panic has subsided. I disagree. The fear from Monday reveals market sentiment and could impact investor psychology, potentially turning market cracks into chasms. Recent events suggest a shift in market dynamics. Monday's panic followed disappointing job figures from the previous Friday, highlighting a loss of confidence in a soft economic landing. Investors are now concerned that the Federal Reserve is too slow to cut rates as the economy weakens, rather than fearing that the economy is too strong for rate cuts. This new perspective means investors will view the economy differently and may overreact to data. For instance, Thursday's slight drop in jobless claims led to a significant market jump. Even if the situation stabilizes, expect a bumpy road ahead. Let's expand the conversation and look at some data that I want to show you. The number of U.S. bankruptcies under Chapter 11 has surged to 2,462, the highest in 13 years. Chapter 11 allows companies to stay in business while restructuring their finances under court supervision. These bankruptcies have more than doubled in just 2 years. This spike follows companies struggling with debt payments after the Fed raised interest rates to their highest level in 23 years. Now markets are anticipating 50 basis point rate cuts as the U.S. teeters on the edge of a recession. How is this a soft landing? U.S. consumer spending is slowing down. Consumer revolving credit declined by $1.7 billion in June, the largest drop since March 2021. Month over month, it contracted by 0.13%, marking the second decrease in the last 3 months. For context, in the 6 years before the 2020 pandemic, the U.S. saw only 5 months of revolving credit declines. The 3-month moving average growth has been falling for over 2 years, the longest streak since the 2008 financial crisis. This follows the average credit card interest rate, reaching a record 22.8% in Q2 2024. Americans can no longer afford more credit. U.S. credit card serious delinquency rates jumped to 7% in Q2 2024, the highest since 2011. Since 2022, 90-plus day delinquencies have more than doubled. Auto loan serious delinquencies have also surged to 3%, their highest in 14 years. With 600 million credit card accounts and 110 million auto loan accounts in the U.S., this means 42 million credit cards and 3.3 million auto loans are on the brink of default. Financial pressure on U.S. consumers continues to rise. The rich are getting richer faster than ever. The top 40% of U.S. income earners now hold 83% of the total net worth, near an all-time high. The top 20% alone account for 71% of the wealth, up 10 percentage points over the past 2 decades. In contrast, the bottom 40% hold just 8% of the wealth, while the bottom 20% have a mere 3%. Over the last few years, the rich have gotten significantly richer, while most consumers continue to struggle. Market sentiment has shifted from euphoria to extreme pessimism in just weeks. The Ned Davis Research Daily Trading Sentiment Index has dropped to 28.9, its lowest since the 2022 bear market low. Historically, when this index hits extreme pessimism, the S&P 500 often experiences a short-term bounce. During bull markets, this usually leads to a continuation of the uptrend. However, if such a drop occurs during a recession, the market often sees further declines after the bounce. Can we avoid a bear market? How much have prices increased over the last 24 years? U.S. hospital services, plus 256% college tuition and fees, plus 188% college textbooks, plus 158% childcare or nursery school, plus 139% medical care services, plus 136%. In contrast, TVs, 98% toys, 74% computer software, 74%. To put this into perspective, average hourly wages have increased by 119% since 2000. Wage growth is struggling to keep up with rising costs. With that said, let's add some context and check the S&P 500 heat map. What's going on here? Apple was down 1.65%, while Meta was up 6%. Nvidia fell 2.35%, and Eli Lilly surged more than 10%. Amazon and Microsoft were flat for the week, and Tesla was down 3.69%. Wall Street Fear and Greed Index. Now at 24, we're back in extreme fear territory. Would you buy the dip here? This week's most notable earnings Monday. Barrick Gold, Monday.com. Tuesday, Home Depot, On, Melco Resorts and Entertainment. New Holdings, Sea Limited, Hut 8 Mining. Wednesday, Cisco Systems, Brinker International, Dole, UBS. Thursday, Walmart, Alibaba, JD.com, Applied Materials, Deere & Company. Friday, there is no earnings. That I'm gonna be interested. Let's expand the conversation and look at some charts. We'll start with SPI. Bull case. If the price stays above 533 and potentially revisits 549, consider buying. Bear case. If the price falls below and closes at 523, we're likely to see a new low. Next chart. QQQ weekly and 4-hour charts. The bigger picture suggests this week could favor the bulls. If the price surpasses and stays above 475, the bulls will likely prevail, and the market could move higher. However, If the price is rejected at 475, which aligns with the Fibonacci 0.618 level, also known as the golden pocket, we might see an ABC pattern developing and potentially more pain ahead. Key events. This week, Tuesday, Home Depot earnings, US PPI inflation report. Wednesday, US CPI inflation report, Cisco Systems earnings. Thursday, Walmart earnings, initial jobless claims, US retail sales report, NY Fed manufacturing survey, Philly Fed manufacturing survey. Friday, US consumer sentiment report. All right, ladies and gentlemen, that's all for this weekend's video. If you found value in it, please like and subscribe. If you have any questions, feel free to ask, and I'll get back to you as soon as possible. Thank you for watching, and I'll see you next time. Bye for now.